At 61 years old, David finally opened the Social Security statement he'd been avoiding. He wasn't looking for bad news. He was looking for reassurance. For decades, he'd worked, paid taxes, contributed to a 401k, and told himself that retirement would eventually work itself out. And there it was. A monthly Social Security estimate. It wasn't enough to make him rich, but it was enough to make him feel like the future was at least somewhat predictable. Then he saw another number, 23-4. That was the year he'd heard about in the news. The year Social Security's combined trust fund reserves are projected to run out under current law. And suddenly, the number on his retirement statement didn't feel quite as certain as it had 5 minutes earlier. But here's the part most people get wrong. Social Security is not projected to simply disappear in 2034. That's not what the government is saying. The problem is much more complicated. And for someone like David, that complication could matter more than the headline. Because the real retirement question isn't whether Social Security will exist. It's how much of the benefit you've been expecting will actually be there under the rules that eventually apply. The latest 2026 trustees report projects that the combined Social Security trust funds can pay all scheduled benefits through 2034. After that, if Congress makes no changes, continuing income would be enough to pay about 83% of scheduled benefits. But the retirement portion of Social Security faces a tighter timeline. The Old Age and Survivors Insurance Trust Fund, the part most directly connected to retirement benefits, is projected to become depleted in the fourth quarter of 2032. At that point, continuing income would cover about 78% of scheduled OASI benefits. So this isn't a story about a giant government vault suddenly becoming empty. It's a story about a system where the money coming in is no longer projected to be enough to cover everything currently promised. And that creates a problem that doesn't stay in Washington. It eventually reaches people's kitchens, their bank accounts, their retirement budgets, and their plans for the next 20 or 30 years. To understand why, imagine David sitting at his kitchen table. His retirement plan has 3 columns: his 401k, his personal savings, and Social Security. The first 2 numbers can move. Markets can rise or fall, expenses can change, savings can grow or shrink. But Social Security feels different. It feels permanent. That's why people often build their retirement plan around it without realizing how much of the plan depends on one government program remaining financially unchanged. And the strange thing is, Social Security isn't some obscure program that affects a small group of Americans. In March 2026, more than 54 million retired workers were receiving Social Security retirement benefits. The average monthly benefit for a retired worker was about $2,079. For millions of households, that isn't extra money, it's part of the foundation. It's the money that helps pay for groceries, utilities, housing, insurance, and everything else that doesn't stop arriving just because someone stopped working. So when people hear that Social Security faces a financing problem, they shouldn't only think about government budgets, they should think about their own monthly budget. Because if a retirement plan assumes one number, but the future eventually produces another, somebody has to absorb the difference. And that somebody is the retiree. But how did we get here? The answer begins with a system that was designed around one America and now has to operate in another. Social Security is largely financed through payroll taxes. Workers pay into the system while working, and those revenues help finance benefits for people receiving them. For a long time, the system benefited from demographic conditions that were more favorable. But America changed. People began living longer. The number of older Americans grew, and the relationship between workers paying into the system and people receiving benefits became increasingly difficult. Meanwhile, Social Security's own trustees now project that program costs will remain above total income for decades under their current assumptions. And that changes the question. Because once expenses consistently exceed incoming money, there are only so many ways to close the gap. More revenue, lower spending, different benefit rules, or some combination of all 3. And eventually, the political system has to decide which direction to take. But there's another problem David hadn't considered. Even if Congress eventually fixes Social Security, David still has to decide when to claim it, and that decision can permanently change the size of his monthly benefit. For someone born in 1960 or later, full retirement age is 67. Benefits can begin as early as 62, but claiming early can reduce the monthly benefit substantially. Waiting beyond full retirement age can increase the monthly benefit up to age 70. So now David has another question. If Social Security is going to remain part of his retirement, when should he actually take it? And that question becomes much more important when the future of the program is uncertain, because claiming a benefit isn't just pressing a button. It's making a decision that can affect income for the rest of retirement. And David is about to discover that the biggest Social Security mistake may not be claiming too early. It may be something much simpler. Assuming the number on the screen is the number his entire retirement depends on, because that number tells him what the system currently projects. It doesn't tell him what his entire financial future will look like, and that difference is where the real retirement problem begins. The easiest mistake would be to look at David's situation and say, just save more money. But retirement doesn't work that neatly, because the problem isn't simply how much money David has, it's how much money he will need, and how reliable each source of that money really is. Imagine David's retirement budget, his mortgage or rent, food, car insurance, utilities, property taxes, healthcare, unexpected repairs. Maybe helping a family member? None of those expenses care whether Congress solved Social Security's funding problem. They still arrive. And that's why a reduction in scheduled benefits wouldn't necessarily look dramatic on a government spreadsheet. For an individual retiree, it could show up as a monthly shortfall. A few $100s missing from a budget can mean something very different when you're working than when you're 72 and living on a fixed income. This is where the Social Security problem becomes psychological. People tend to think about retirement in terms of a finish line. I'll work until 67, then Social Security starts. Then I'll live on my savings. But retirement isn't a finish line. It's a decades-long cash flow problem. And one of the most dangerous assumptions is believing that today's retirement environment will still exist when you reach retirement. Consider inflation. Social Security benefits receive annual cost of living adjustments. For 2026, the COLA was 2.8%. That sounds reassuring, and it is designed to help benefits keep pace with measured changes in consumer prices. But retirees don't experience inflation as one number. They experience it through their grocery receipt, their insurance bill, their utility statement, their rent, their medical expenses, their car repairs. A retiree doesn't wake up and say, inflation increased by 2.8%. They open the bills, and that's why the amount of Social Security you receive is only half the equation. The other half is what that money can actually buy. Now here's where the story takes an unexpected turn. The biggest Social Security risk may not be that benefits are cut. It may be that people wait too long to prepare for the possibility that the rules could change. That's a completely different problem, because uncertainty encourages procrastination. A 30-year-old thinks retirement is too far away to worry about. A 40-year-old thinks there's still plenty of time. A 50-year-old believes the 401k will eventually catch up, and a 60-year-old starts looking closely at Social Security for the first time. By then, there may be fewer levers left to pull. This is why the Social Security issue matters. Even if you're nowhere near retirement, the earlier you understand how much of your future depends on the program, the more options you have. And options are incredibly valuable in retirement planning. If you have multiple income sources, one problem doesn't necessarily destroy the entire plan. But if Social Security is carrying most of the weight, a change becomes much more painful. This is the difference between dependence and resilience, and it applies far beyond Social Security. Think about a homeowner whose entire retirement plan assumes housing costs will stay exactly where they are, or an investor whose entire retirement depends on one portfolio assumption, or a family that has no emergency savings because every dollar already has a job. The problem isn't that any one assumption is guaranteed to be wrong. The problem is building a plan where nothing is allowed to go wrong. That's not a retirement plan, that's a bet. And Social Security makes this especially complicated because the future isn't determined only by economics. It's also determined by politics. Congress could change taxes. Congress could change benefits. Congress could alter eligibility rules. Congress could combine several changes. The trustees are not predicting exactly which political solution will happen. They're showing what the program's finances look like under current law and current assumptions. That distinction matters, because nobody watching this video can honestly tell you exactly what Social Security will look like 20 years from now. But we don't need to know that. We only need to recognize that the current system has a measurable financing gap, and then ask a much more useful question. What happens to my retirement if the future benefit is different from the one I'm expecting? That question changes the way you plan. Instead of asking, will Social Security be there? You start asking, how much of my retirement can safely depend on it? Instead of asking, what will my monthly benefit be? You ask, what are my expenses likely to be? Instead of assuming everything will work out, you create room for uncertainty. And that is where Social Security stops being just a government problem. It becomes a personal planning problem. But there is one more piece that could make this even more important. The age at which you claim Social Security can permanently affect your monthly benefit. For someone whose full retirement age is 67, claiming at 62 means receiving only 70% of the full retirement benefit. Waiting can produce a larger monthly payment. By age 70, the delayed retirement benefit can be 124% of the full retirement benefit for someone born in 1960 or later. That means the decision isn't simply, do I want my money now? It's, what do I want my retirement income to behave for potentially decades? And suddenly, the Social Security problem becomes much bigger than a trust fund date. It's about timing, it's about longevity, it's about inflation, it's about your other savings, and it's about how much financial flexibility you have when the future doesn't behave exactly as expected. But there is still one question left. If Social Security really is facing a long-term problem, what should an ordinary American actually do about it? Because panic isn't a strategy, and pretending nothing is happening isn't one either. The answer sits somewhere in between. And it starts with one uncomfortable idea. Your retirement plan should be able to survive a future you cannot predict. That doesn't mean David needs to predict what Congress will do. He doesn't. He doesn't need to know whether lawmakers will raise taxes, change benefits, adjust eligibility, or combine several reforms. Those decisions are outside his control. What he can control is how dependent his own retirement plan is on one assumption. The first step is understanding the benefit he is actually projected to receive. Not the number someone mentioned on television. Not the number a friend receives, his number, his earnings record, his claiming age, his circumstances. Social Security provides tools that allow workers to review their earnings history and estimate future benefits. That's important because retirement planning should begin with reality, not a guess. Then comes the harder part. David needs to look at what his retirement could actually cost, not what retirement costs today, what his retirement might cost when he gets there. Because a $2,000 monthly Social Security check sounds very different depending on whether your total monthly expenses are $2,300 or $4,500. The benefit didn't change, the dependency did, and that's the lesson many people miss. A retirement plan doesn't become safer because Social Security exists. It becomes safer when Social Security is one part of a larger plan, savings, investments, retirement accounts, other income, and a realistic understanding of expenses. The goal isn't to replace Social Security. The goal is to avoid making Social Security responsible for everything. And there is another reason this matters. People often think they can solve retirement risk by simply saving more. But the quality of a retirement plan isn't measured only by the size of the account. It's measured by flexibility. What happens if markets fall? What happens if healthcare costs rise? What happens if you live longer than expected? What happens if you need to help a spouse? What happens if Social Security rules change? What happens if you retire earlier than planned? A strong plan has answers to those questions. Not perfect answers, but backup plans. That's resilience. And maybe that's the most important way to think about Social Security, not as something that's either safe or broken, but as one part of a retirement system that is under pressure and may eventually change. Because the 2026 Trustees Report isn't telling Americans to panic. It's telling policymakers that the financing problem cannot simply be ignored, and it's telling individuals something else. Don't build a retirement plan that requires the future to be perfect. Go back to David. At 61, he originally thought the scary number was 2034. He thought the story was about Social Security running out of money. But after digging deeper, he realized that wasn't really the lesson. The lesson was that he had given one number too much power over his future. He had treated Social Security as a certainty instead of treating it as one component of a larger plan. And that changed what he did next. He looked at his actual expenses. He reviewed his savings. He checked his Social Security estimate. He thought about when he might claim. And most importantly, he asked a question he'd never asked before. What happens if things don't go exactly the way I expect? That question doesn't create fear. It creates options. And options are what make retirement plans stronger. Because the truth is, Social Security may still be there for the next generation. The government is not projecting that benefits simply vanish. The current projection is that the combined trust funds can pay scheduled benefits through 2034, with continuing income covering a substantial portion of scheduled benefits afterward if no legislative changes are made. But the exact future is still uncertain. And that's precisely why waiting for certainty is dangerous. You don't need to know exactly what Congress will do. You need to know what you will do if Congress changes something. You don't need to predict inflation perfectly. You need a plan that can handle higher expenses. You don't need to know exactly how long you'll live. You need to understand that retirement could last much longer than you imagine. And you don't need to be wealthy to start thinking this way. You just need to stop assuming that tomorrow will look exactly like today. That's the bigger retirement problem hiding behind Social Security. Not that the system suddenly disappears, not that every retiree wakes up one morning with nothing, but that millions of Americans may discover too late that they built a retirement plan around assumptions they never tested. And the earlier you test those assumptions, the more choices you have. Maybe the most important number in your retirement plan isn't 23 to dot. It isn't 2034. It isn't even your projected Social Security benefit. It's the number of different ways your financial plan can survive if something changes. Because retirement isn't about predicting the future. It's about preparing for it. And if Social Security teaches us anything, it's this. The safest financial plan isn't the one that assumes nothing will go wrong. It's the one that can keep working when something does. If you want more documentaries about the money decisions shaping America's future, subscribe to MSBT Finance.